What are index funds? They are designed to replicate the performance of a specified basket of underlying securities. Index funds are also called index trackers, as they track the performance of its benchmark, composed of underlying securities. The first index fund, aimed at individual investors, was the Vanguard 500 Index Fund, launched on August 31, 1976, tracking the performance of the 500 largest publicly traded companies in the United States. This is an important milestone in financial history, because it allowed individual investors the opportunity to invest passively, and buy the whole market, instead of attempting to beat the market by actively selecting stocks. Back in 1976, the market for individual investing was dominated by actively managed mutual funds, which charged a lot and underperformed on average. Does this matter to you today? Yes? Actively managed funds, be they mutual funds or ETFs or hedge funds, still underperform today. You, individual investor, will be better off by passively investing in index funds, as we shall see. Let's start with the context. The investment landscape in the early 1970s. As seen here before, the world's first mutual fund was launched in Amsterdam, 1774. The goal was to provide small investors with limited means and opportunity to diversify. The result? The buyers of this mutual fund almost got wiped out, losing 75% of their money by 1811. But the mutual fund sellers and managers still got their fees paid every year. Centuries later, right after World War II, the mutual fund industry grew fast in the U.S. How did it work? It sold actively managed funds to individual investors, who paid annual fees averaging as much as 2% of their funds. Active managers then proceeded to select stocks they hoped would perform well. They were paid the annual fees regardless of their performance. Unfortunately for the individual investor, performance was usually not good. Evidence criticizing active mutual funds started to appear. In 1962, the Securities and Exchange Commission commissioned a study to the Wharton School of Business. This study showed that the performance of the mutual funds lagged the performance of a random portfolio of securities. In other words, investors would have been better off randomly picking stocks themselves, rather than buying active mutual funds. Additional evidence on the underperformance of mutual funds was produced by Michael Jensen in 1969. He showed that the risk-adjusted performance of the 115 mutual funds in his sample trailed the market. In other words, investors would have been better off investing in the entire market, rather than buying an active fund that attempts to pick the better-performing stocks. By the late 1960s, the dismal performance of many mutual funds, and the high fees extracted from the public, led to media attention and political scrutiny. The U.S. Senate was considering new legislation to deal with the growing mutual fund industry. In 1967, famed economist Paul Samuelson testified before the U.S. Senate Banking Committee, and stated,
"There was only one place to make money in the mutual fund business, as there is only one place for a temperate man to be in a saloon, behind the bar and not in front of the bar."
Samuelson also cited a recent Yale PhD dissertation, which showed how a random 20-stock portfolio outperformed the mutual fund industry. When asked by the senators what was meant by random, Samuelson clarified,
"When I say random, I want you to think of dice or a dart."
Instead of getting skinned by mutual funds, some observers suggested passive or index funds. Rather than attempting to beat the market, why not just buy the market? But active fund managers showed no interest in this, as it would cannibalize their very profitable business. And so, an industry outsider stepped in. In 1972, Wells Fargo received approval to launch an index fund tracking the S&P 500 for institutional investors. Individual investors would be next, and soon. The first index fund for individual investors was created by John Bogle at Vanguard. As he wrote, in late 1975, at a board meeting at Vanguard, the directors approved his proposal to launch the world's first index mutual fund. But Bogle also writes that it was not an easy sell. It took effort to persuade the conservative board members to approve this innovation, which ran counter to the then deeply embedded notion that the active management of other people's money was necessary. How did Bogle convince the board? With more evidence showing the bad performance of mutual funds. Bogle shared a paper by Samuelson, who pleaded for some institution to set up a portfolio that tracked the S&P 500 index. And second, Bogle showed his own analysis. The S&P 500 earned an average annual return of 11.3%, whereas the average mutual fund returned only 9.7%. The Vanguard board approved Bogle's idea, and Vanguard's index fund was launched on August 31, 1976. After the 1976 launch of the Vanguard Index Fund, others followed, and more index funds were launched. And thus began the slow but steady rise of the index fund, which took share from active funds year after year. The latest reading shows that index funds account for more than half of assets under management in the U.S. How about active mutual funds? Do they still underperform today? Yes, active mutual funds still underperform on average, as shown by Cuthbertson and colleagues. In 2022, the New York Times showed that not a single active mutual fund out of over 2,000 beat the market in the previous 5 years. Active investing has not changed since the first mutual fund in 1774. The seller will always win, and the buyer will almost always lose. Today, Morningstar reports that the average expense ratio for active U.S. mutual funds is 0.6%. For index funds, the average cost is 0.1%. Why would investors pay more for something that underperforms? Our verified sources are shown here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. What are the takeaways for you? Today's takeaway is as simple as it gets. There's no reason for you to choose an active fund over a passive fund unless you want to lose money. And if you think you can pick the active funds that will outperform, know that there's plenty of evidence showing that active fund performance reverts to the mean. In other words, the best performers in the past 5 or 10 years are unlikely to be the best performers in the future. Godspeed. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.